Hello and welcome to joining me in my analysis of likely action for the euro dollar in days and weeks to come, and I will hope to take you through sequences that I have used in order to build my view both for intermediate term and for longer term. My Twitter feed is Twitter at Danji, DHANJIV, DanjiV, and the analysis I'm presenting is in no shape or form or under any circumstance. It is not to be interpreted as an advice or recommendation or an inducement for you to engage in the financial market whatsoever. It is purely intended for educational purposes and simply to outline what I am currently looking at and how I am interpreting the chart, and each individual, when they view this, will be able to use their own analysis for their particular circumstance and requirement. So no responsibility for any potential losses or otherwise by use of my analysis. So you're using this simply as an educational material. Now, many analysts will be able to forecast which way the euro is heading by using technical analysis or fundamental or combination of both, and there will be just as many variant views as there are technical analysts. So I am presenting to you simply my view, and I hope it will be useful to you as you compare or set about to carry out your own analysis. So the first thing I'm going to show you is this particular website that you are able to access. It's usinflationcalculator.com, and what I've done is I said to myself that we are in 2013, but if I was 100 years back in history at 1913 and I spent $1 to buy goods or services or whatever, $1, how much would it cost me now? Well, that dollar has lost its value to such an extent that I'd have to spend $23.45 in today's money. So in terms of the normal calculation, that would indicate that the dollar of 1913 has $23.45 of today's money to equal the dollar in 1913. So what that means is that if I take out $1 now, then it would only be worth approximately 5% of the dollar back in 1913. So in other words, 5 cents back in 1913 would be almost equivalent to today's dollar. So in today's dollar has actually lost nearly 95% of the purchasing power of the dollar back in 1913. That's basically what I'm trying to indicate. So one could begin to imagine that if the dollar had a purchasing power of $1, and we have now dropped down to almost like a 5 cents of that, today's dollar is only worth 5 cents of the purchasing power of $1 back in 1913. So we started from the top left hand corner on a chart, if there was one, and then we will be arriving to the very bottom right hand corner of that chart. So question then arises, how did that dollar get there? What sort of shape, what sort of pattern, what sort of chart did it follow? Well, I think the dollar index in the sense that we see today didn't actually exist back in 1913, so it's difficult to say. But one could postulate that maybe we've had sequences of a very long up and down movement with basically lower lows and lower highs to the extent where we've got now. So just with that basic concept, let me now show you my dollar chart, that this one takes us back to February 1972. So since 1972, you can imagine that we've been coming down from the top left hand corner, and I would suspect that we would be in some major big wave 3 in parenthesis, and then we had a sharp retracement of wave 4. Now it is possible that if we've had a wave 2, wherever that was some kind of a general flat kind of a pattern, then this one would be a very sharp up pattern showing ABC to the upside, which often do show itself in the wave 4. So I'm assuming in my analysis that this is the bottom of wave 3, a very big cycle wave 3, a very big cycle wave 4, and now we are in the probably back end of that big cycle wave 5. And one of the reasons why I think we are in a big cycle wave 5 is, if you look, since the drop from there, we had a very powerful drop in wave 1, I think. Then we had a retracement in wave 2. Then wave 3 seemed to have been shorter than that. So, and I'm assuming this is wave 3 based on my chart here, that this is wave 1 up to here. Then we have ABC retracement back there for wave 2, and we drop down for wave 3, and then current congestion in my understanding is probably wave 4, and we will then drop down to make a final wave of 5. So that part of the chart already begins to look like, in Elliott wave terms, like an ending diagonal. So in ending diagonal you have a very long wave 1 retracement and a relatively shorter wave 3, some sort of a retracement or congestion, and then even shorter wave 5. So that would then give us a picture of possibly an ending diagonal. And if it is going to be an ending diagonal, then I'm picking up a bottom here, probably a significant bottom at a range of bottom of wave 3, connecting that with the wave 1 to give me some sort of a trend line. And fortunately also this low here, which is the low of wave 3, comes and lands straight on that particular trend line. So if we continue with that, then possibly when we finish this ending diagonal, we could come back to that trend line to mark the final bottom. And secondly, they say that wave 3 has the strongest momentum. Even though this was very sharp, the momentum on that one was lacking. For example, if you look at the RSI that I have here is 14 period on this monthly chart, the momentum on this wave 3 is the highest in the sequence starting from this high here. So those things give me some enough confidence to assume that what I am looking at is a potential ending wave, and if it is an ending wave, it must be an ending wave, wave 5, or it might be an ending wave in a form of a wave C. But I think if you were looking at a dollar declining from 1913 to current 2013 and losing nearly 95% of value, chances are it's not going to be A, B, C. So I am assuming we probably had a 5 impulsive move down, and this possibly being the ending diagonal might be the end of that big cycle 5 wave down. So coming a little bit closer now, if we look at this, many analysts are saying that this bottom we had was a very important bottom, and we are going to make a retracement straight from here back towards something like 100, 110 on dollar index. But based on the explanation I just gave you now, where I think this is likely to be an ending diagonal, and if this wave 3 has the highest momentum, then chances are that we are currently congesting in this period here, which to me looks like a running flat. Okay, and let me share with you one other chart. This chart here, which I originally sketched out back in September 2012 and presented it to some colleagues and friends and a small group of subscribers. So looking at that last wave here, I think we've got that ending diagonal, and if you look at a wave 4 with my limited knowledge of Elliott wave, and I think to myself, which of these fit into this picture? So we have a possible regular flat, which is simply ABC. Could be a normal zigzag. It could be A, B, and C. But you know, in general term, we call that this one like a regular flat, and it's not a zigzag. Then it could be an irregular flat where you have wave A, wave B going beyond the origin of wave A, and then wave C goes beyond the origin of wave B. So that could be an expanding flat. And then the other one, it could be a triangle like this one. you know, where you have A, B, C, D, E, which could also happen here. So we would have wave A here, maybe wave B, wave C, wave D, and then we'll go back to the dropping trend line to form a wave E before we have that final leg down. That would fit this picture. And the other one is this one called running flat. And what running flat does, it shows you like it's a wave A, B and C, but it is inclined or slanted in the direction of the main trend. So it is trying to correct the wave 3, but the movement down is so strong that it cannot really make a normal zigzag A, B and C to the upside, or even a flat where you have A, B and C. It cannot do that. It is slanting in the direction of the main trend, so they call that running flat. So I think out of all these, my perception or review is that this is probably the likely scenario, or we might have this one. If we have this one, then I expect the dollar index to drop down to this rising trend line, then bounce back up to the falling trend line, and then make the final leg down. But if it is this one, then I think we are near enough complete, in a sense that we have this here as a wave A, B and C down for wave B, and effectively we are now doing this wave C. Okay, and we are close to completing wave C, which might in itself be A, B and C, with a C being truncated wave, and I'll come to that in a bit more detail. But this is the reason why I'm thinking this is wave 4, and we are in a running flat in a wave 4, which if it completes now, then it can begin a new minor 5 wave down to complete this last leg. Okay, and that last leg could bring us to a region somewhere about 68, as I pointed out in the other chart. Okay, so let's go back to this chart then. So personally, I think that we are in that final stage. We are currently completing this wave 4, and we should really decline, and the easiest and the least painful would be simply a correction straight down, because that way this trend line suggests that we might bottom out close to 69 or maybe even 70. Maybe we would simply have a small marginal lower low compared with this low we had back in 2008. Okay, marginal lower low, and then the dollar will begin to rise again, and it would probably rise for several years, more than a decade, I would think, because remember, we would be correcting this big massive cycle of 5 wave down. We'll be correcting that. So I would not then be surprised for this one to last for maybe a decade or two, to continue staircasing up as a part of a correction of all that 5 wave down. And often they say that it goes back to the wave 4 of the previous lower cycle. So this is the wave 4. So in other words, we could be very well going into an area something like 160, 170 area in time, and that wouldn't happen within few years. It would take several years. I'd probably think maybe a couple of decades for that to happen. So first of all, dollar is likely to bottom out around 69 or 70 as an absolute cautious downside target, or more likely around 66 to 68. The other scenario is where we have this triangle. Is in that case we would find that this one was wave A, ABC down as the wave B. We've completed wave C. Will come down to this here rising trend line to form a wave D. Then we'll go back up to create a wave E. Now that is still possible, so I'm not completely ruling that out. It is possible, but it would mean the period for it to go back up would take another year or two. It would decline maybe another year or two to go back up and then come down, meaning that overall we are going to be reaching the bottom possibly in next 3-4 years or so, maybe longer even, and entirely feasible. That is feasible, but I think where we see equity market going over the next couple of years, and several other analyses I have carried out suggest to me that we might not actually do that. We might be in a running flat where wave 4 is nearly complete, and we will be simply now cascading down into wave 5. Just excuse me a second. pardon for that interruption. So now we have a possibly running flat, and I think we are going to decline into 5 wave to the downside. So that is my current view, and as I said, the other option of contracting triangle is something I do keep in back of my mind, and I will not completely dismiss it, but I think the easiest option that I see is for dollar index to simply decline as being the least painful. Okay, so with that understanding, let me now take you to the other chart. This one here is a dollar index at the bottom, and we have Dow Jones Industrial at the top. The point I'm making from this one is that generally speaking, the common relationship is that when the dollar index is rising, we should be expecting equity to be falling because it is measured in dollars. So if the dollar gets stronger, then generally speaking, any asset that we measure in dollar terms should weaken. So if equity represent one of the asset class, then the equity market should come down whilst the dollar is going up. Now generally that's a common relationship. It's not exactly 100%, and it's not very static relationship. It is a dynamic, and it is less than 100%. So there are times when they both go together. There are times when they behave normally as we would expect, and there are also times when either the index, dollar index, could lead the new trend or new motion, and equity will then follow, or there are times when equity leads it first and then the dollar index follows soon after. So with those provision in mind, we look at this area here, and I've highlighted just general area with these red vertical lines to help compare with what happens in the relationship of the equity market represented by Dow Jones Industrial 30 and the dollar index. So here we have dollar index coming down, sorry, the Dow Jones Industrial coming down and the dollar index coming down. So they're both doing same thing together. Then we find that the Dow Jones continue to come down and the dollar index begins to run the opposite way, which is the normal relationship. And again we have equity market rising up, dollar index falling. Then we have a dollar index rising and equity market simply just going sideways. Then we have dollar index falling, we have equity market going up. Then from then, which is basically from September 2011, we've had equity market simply just make higher high and higher low to the extent we are now. And we have the dollar index which went sideways for a short while, but then dollar index also has been rising up. We had a short period when dollar index declined, when the equity market, for example, was still rising, and then the equity market basically just went sideways to some extent, but the dollar index also went sideways at the bottom of its range. And dollar index since has been rising since the beginning of this year. Dollar index been rising, and here we have equity market also rising. So we would expect this relationship to break down, which is both rising together, and reassert its normal relationship where equity index go up and the dollar index should come down, or dollar index should go up and equity index should come down. That would be the normal relationship, but for the time being they're both going together, and whilst they're continuing together, we would expect them to act together, behave similarly. So if you now just look at in a closer look, you'll see that since that period we've been rising strongly on a dollar index, and the equity market seemed to be rising up as well. But the equity market from this area here, which is back in November, and I will show you this on another chart, but at the moment if you simply look at it, it looks like we've had a wave 1 up to here, retracement wave 2, and then we are in a wave 3, and within the wave 3 we've probably got minor 1, minor 2, minor 3, minor 4 and minor 5, which is almost done. So if the minor 5 is done, we expect a small retracement for equity and then a further leg up to complete the upside of the 5 wave to the upside from low of November. And horizontally, this line here is an area where 2007 high was, which is just below where I've drawn this line. In fact, if you actually, it was just shy of up to here, 14,198 is an area where the 2000 high was. We've simply on a Dow Jones gone a little bit higher, and therefore we will probably come back to retest that and try and make another leg up. But what is the dollar index is doing is it will also do the same thing whilst they're in a sync. Sync meaning they're both doing same thing together. However, this red line you see here plus this declining brown trend line, they both are potential resistance for dollar index. So dollar index is running into potential resistance, whereas the equity market don't have any real resistance anymore. It is in all-time high. So there is more chances for dollar index to actually hit the resistance and possibly decline, whereas the equity market could come back down to retest the 2007 high, which it broke above that, retest that, and maybe try and build another leg up. So equity market don't have an immediate resistance, it can go up a little bit longer, whereas the dollar index is running right into the resistance and is likely to correct. So there are a couple of things we can conclude from here, is that we will get a small pullback on a dollar equity market. We will also get a pullback on the dollar index. Then when the equity market begins to run up, the dollar index could join, or dollar index could deviate into a normal relationship. So it would then begin to decline. So my current view is that if we have a marginal higher high from here, for example, if we did a small pullback and then we went up here, make another high, sorry, let me just put that line again. Okay, so if we, for example, continued higher, a little bit difficult to maneuver these lines because they're close to the others and you start maneuvering and the overall other lines move as well. Okay, so this is what I'm looking at. I'm looking at potentially a dollar index maybe topping out fairly soon, which would be only an intermediate top, not the big top, only a minor top. If it tops out soon, then declines, which I think will be again a minor decline, and then it would go up to form a new top to complete this 5-wave up. So we'd have wave 1, wave 2, when it makes an intermediate top here, wave 3, declining to wave 4, and then continuing to wave 5. Okay, so when that is happening, I suspect that the dollar index is very close to the trend line. It is likely to break below the trend, and then when the equity index continue higher, dollar index will refuse to go higher and will actually start declining. So longer term, based on this chart, where we are expecting longer term dollar index to actually weaken quite noticeably, then it would follow that this dollar index will fail this uptrend line now and probably fall below, and it will come back to this recent low range we had. It might act as a potential support, but it might only be just a bounce, and second time around it will probably break below as it begins to make a new 5-wave to the downside, assuming that we have concluded that wave 4 congestion on this chart, wave 4 congestion on this chart, in which case we would find this dollar index to start making new 5-wave move to the downside. Eventually it would lead it to retest this low we had back in 2011 and maybe continue on to make a new lower low from there, whereas the equity index will still continue to make higher high. Okay, so that's my general concept and canvas behind where I am looking to form a view on what the euro dollar is going to do in this current wave to the upside. So I will now take you to the euro dollar and dollar index chart. So this is the overlaid of dollar index. In green and yellow is the dollar index, and this red and blue is the euro. So we basically notice now that the dollar index should be reaching the top of that wave 4 I showed in the other chart. So from the bottom it would seem that I can probably label this one as wave 1, and then this low here is a wave 2, and I'll explain in a moment why I'm doing that. Then we have wave 3 top here, which is quite difficult to actually number, but I think it's a wave 3, and then currently we are in a wave 4, and that triangle is probably part of wave 4, and we are going to be making a new high which will be wave 5. Okay, which will be wave 5. Now before I proceed with this chart, I think it will be good idea if I actually show you why I'm labeling those 5 waves. Okay, so the reason why I'm labeling those 5 waves is this dollar index chart. We had a high in July, we came down in what looks like to be an A, B and C kind of a move, and then over here we have a bounce, which is, you can see quite clearly, it's a small a, small b and small c. So I've labeled that one as a larger wave A in double bracket. Then we had an A, B and C down, so I'm labeling that as a wave B in double bracket. And what we are now doing is a wave C. Now in Elliott wave they call this approximately expanding, not an expanding flat, they call this one flat correction. Okay, flat correction. And flat correction would be qualified once you do a retracement of this wave up and you retrace more than, you know, like 88% or close to 90%, then it becomes a flat correction. Whereas normally you see a zigzag, you see A, B and C zigzag. Well, this one didn't have that. What it should have had, it should have had simply A, B and C. That's what it should have had, but it didn't have that because it bounced up in ABC zigzag, it came down in ABC zigzag and retraced more than 80%, so it's qualified for a flat. And then we have this wave C. So we had wave A, wave B and wave C, and this is the sort of a diagrammatic idea about this flat. So we had ABC up for wave A, ABC down for wave B, and in case wave C will be 5 wave up. So if this is following that, then currently we are in a 5 wave up which would terminate, and then that would end this current cycle up, and we would then revert back to the downside. Okay, so that's the reason why I'm labeling this 5 wave up. So if I now go back to this other chart, then this overlaid chart, then from here we've gone up wave 1, wave 2, this here is entirely wave 3, and currently it looks like a triangle, so we may even have a bottom of the triangle here on the close on Friday, and this is 4-hourly chart, and we should then make another leg up higher high. Okay, so if he makes another higher high, then quite possibly we may top out in that area above the high we had week before. So in the same time we have a euro dollar coming down, and a euro dollar is approximately 68% weighting in the dollar index. And then of course you have other currencies like Swissy, which makes up probably another 10. So between Swissy and euro, they probably make up well over 72 to 75%. And then the balance is made up of British pound, another 10-11%, 10-11% also for Japanese yen, and then the final small portion will probably be something like a Norwegian krona. Sorry, Canadian dollar. Okay, so with this now in mind, we've had a 5 wave up, which you can see if this is wave 4, that means we must have another wave 5. And the reason why I'm thinking this is wave 4 is from here I can count a minor 5 wave up. I can count this one as 1, ABC as a 2, wave 3, wave 4 and wave 5. So that's wave 1, wave 2 down, and then this is quite complex, wave 5. And again it would be done as a wave 1 over here, ABC retracement wave 2, then possibly up to here is a wave 3, ABC wave 4, and then finally 5 wave is probably a contracting ending diagonal. So all of that gives me up to wave 3. And then we have A, B and C. Okay, so they have 3 threes. A, B, C for wave A, B, C for wave B, A, B, C for wave C. So we should now really be looking to go up. So the dollar index has a potential of making another leg up to the upside. And at the same time, we have a euro dollar coming down. But euro dollar, because as I just suggested, that it is not 100% of dollar index, and so sometimes you find they follow almost identical and the waves are very, very similar, and at other times the waves are somewhat different. So in this particular case, we can't, no matter how we struggle, I am finding it difficult in labeling this wave which came up to here, that as a wave 1, because it looks more like wave A, wave B and wave C, which is 1, 2, 3, 4 and 5. I can't label it as 5 wave. So in that particular context, I will have to probably revert to something different. I might say, for example, this one here is a wave A, a small wave A. Then this one could be small wave B. And then this one could be small wave C. So if that's the case, then we have ABC. So either it would form a larger wave A, or I will contrast it by making it look that it is a wave W. Okay, so wave W. Then to correspond with this, because this one here is wave 1, wave 2, so here we have W, we could have an X there, but when I was looking at the RSI on the euro, this although it's a lower low, on the RSI it's a higher high. So maybe what I've got is this here is a expanded flat, an expanded flat. So in other words, is wave W, and then this one comes down as a wave X. Then after that we develop wave 3 on the dollar index right up to here. But in the euro, I think we have wave A, wave B and wave C. So let me just put those in. So we have wave A here, wave B there, and this is wave C, and wave C also is got 1, 2, 3, 4 and 5. Okay, so that's a wave C. So that gives me a wave W, wave Y, and then from there we have, just like over here, another ABC, and therefore we've got another expanding flat, and in which case what we have is we have wave A, ABC down as wave B, and this one being wave C. So that gives me another X. So we've already had ABC for W, X, ABC for Y, so we should expect another ABC for Z. And in that we've got this here looks like 1, 2, 3, 4 and 5 to give me wave A. This is retracement ABC back, and so we should get another leg down. So if I now go ahead and place this one as wave A, then we have wave B here. Therefore we should have leg C to complete what this might turn out to be a triple zigzag. So whilst in this case we have from here dollar making new high, we should get a new low in the euro. So that's my current directional bias for, you know, maybe this current week. You see over here, since the last weekend we had a weekend open, we had a gap down, and we spent whole week in doing this. So it's quite possible that we might spend a whole week in forming this leg down. So maybe we would be getting euro bottoming out toward the back end of the week. I don't think that we will complete this entire leg, because it will be very disproportionate if we spend if we spend this amount of time for a wave A and B, now to get a wave C finish by simply 1 day trading, it could happen, but I think it will look very disproportionate. So my view is that on this 4-hour chart, if for example from here we have a similar sort of time which is like 14, 12, 13 bars, 12 to 13 bars, then 12 to 13 bars from here would bring me to something like there. Okay, so let me just put a line there and now measure 13 bars. So we need, okay, so measure it again. Approximately there. So that's with the 13 4-hour bars from here to there approximately, and that would bring us to something like 25th. Okay, now 25th obviously is tomorrow. So, and we've had the weekend in between. So we have to take away 2 days and add some, because Saturday and Sunday the market was closed, we couldn't get the usual 4-bar sequences. So I think this is going to be toward the back end of the week when we are going to get those 14 bars, and we would then find that the bottom in the euro is in. Where is the bottom going to be? We'll look at that in a moment. But now, having confirmed that based on the dollar index, it's got a 1 leg up, so the euro must have a 1 leg down, and they should both finish those approximately toward the back end of the week. So maybe the whole week we would find euro continue to decline, where the dollar index continue higher up. An upside target for dollar index, we could be looking at 83.50 to maybe 84, and in a corresponding way the euro could be declining. So we'll look at that in a second, but that's the reason why I have labeled the dollar index in a 5-wave in the way that I have, and to correspond with that we're going to get triple zigzag to the downside. If you get a triple zigzag to the downside, then what would happen is that once this 5-wave to the upside is finished, dollar index will decline, and based on my running flat idea I explained on a monthly chart, this might be the end of a wave 4 congestion on dollar index, in which case dollar index will do new 5-wave decline to the downside, which will last for several months. Okay, in terms of the height of the dollar index, if we do the retracement of this leg declining from the high in July, then we've already reached the 78% retracement. So maybe it could go on for 88% retracement, 88.6. So that will bring us to something like 83.50. So that I think is likely. We could head into that 83.50 area where the dollar index would top out, and we would then see dollar index declining very strongly. And secondly, if you have this minor pitchfork rising, which is pivoted on the high we had back in January, and then the low we had here in February, then we've got the median line hooked on this December, and that gives us this rising pitchfork, and currently we're bumping against that as a form of resistance, and it's going to fail, I think, by the time we get to 88% retracement, approximately 83.50 on the dollar index. So in the same way, where is that going to lead the euro? So let me now take you to the euro chart. So this is the euro chart, and we've got this triple zigzag we just pointed out. On the daily perspective, we have currently 50% retracement, which is where we are now. If it made 61.8% retracement, we could actually come all the way down to 126.87. So if you make that a rounding up number, then probably close to 127. So maybe 127 could be the downside target for the euro, or maybe even a little bit lower. Ideally 61.8% retracement of the entire rise from the July high. And then subsequently we would find that the dollar index begins to decline in a big way, and the euro will make its major rally from then on. If we find that the dollar index continues to decline to this kind of level here that I suggested, then you can imagine that in a corresponding move, the euro would most likely move to the upside over a period, not in a month or two, but over a period. And whilst the dollar begins to probe its all-time low, the euro is most likely probe its all-time high. So from the current perspective, this is what I think we are going to be heading into, is that we have a possibility of a decline of this next leg down, and currently we are forming this divergence, and it's quite possible that divergence also on a daily and on a 4-hour, but I think that divergence might hold or it might fail. It might fail on this current degree. So if we make a new low and this one continue plumb down here 27, then by that time the shorter term divergence on the dollar index or even euro, shorter term divergence on the euro is going to fail, and we might find the euro falls a little bit further down, like so. Before, so there will still be a divergence, but the current divergence in progress I think is going to fail. This divergence we are looking at is probably going to fail. It might hold, but otherwise it fails. If it does fail, then I think we'll get another low on the RSI, but it won't be lower than the low we already had over here. So technically it will still give us the divergence from which to project to the upside. But what are we going to be expecting is this, that we have these two possible pattern, and there's no way of knowing, of course. I mean, the alternative would be is that we would get this. Let me just show you. We would get possibly from here a move up and back down again. Okay, that is possible. So let me change the color of that. So we might get something like a like ABC up and then another leg down. So that would be like this one could be like a wave A, ABC back for a B, and then going even deeper down for wave C. So that could be one possible scenario. But I think based on the view that we've just considered using the dollar index chart and longer term expectation from dollar index and the corresponding move from the euro, I think this one I've just shown in brown probably will not materialize. So what will materialize, I think, is either a pattern A or a pattern B. So this low we had is a low in July and a low in July on this one, which we know where we come from. Then since then we have a September high as a wave W, then November low as a wave X, and then the February high as a wave Y, and currently in progress to form a wave X again, and we'll go up. So we'll get W, X, Y, X, Z, triple zigzag. Okay, so that would mean that the euro will begin to continue building a new 5-wave move to the upside to retest the February high and maybe even make a new high as a part of this pattern. Then it would have some retracement, but broadly speaking it will be creating larger degree higher high and higher low, just like the dollar index is likely to do with a 5-wave move to the downside. And the second possibility is that we've got a July low, September high is a wave A, November low is a wave B, and then this February high as a wave C. So we have ABC up, we come down in a wave X, and we do another ABC up, just like we did one from July low to the February high. We'll do another ABC up, so that could be pattern B. Most likely I would favor pattern B, but the cautious view would be pattern A, because in a pattern A, before we get another decline or retracement, we're only expecting this one to rise up to retest February high and maybe make another little bit higher high around 38 or so. But if we were going to go for this one, then we will be looking at like AB equals CD, equal move. That would take us to something like 140, 141 and even higher. So let me just see if I have another chart here that I can use to show you what I mean. Okay, so here, if we had A, B, and C, and currently forming wave X, and then go for another A, B, and C, then we have AB equals CD, right? Possibly taking us to something like 145, 146 area. And I wouldn't be surprised if we actually get that. But I think initially I would at least expect this pattern A to play out. So that pattern A is only calling for one more leg up before retracing some back and then progressing to the upside. But based on the fact that the dollar index is expected to do either A, B, and then 5-wave down, if it was a contracting triangle, if that was the case, then on the euro, we are likely to do something similar. On a euro, we are likely to do, for example, we are likely to do this one, pattern A. So we do leg up, and then we decline before we continue with a 5-wave up, or what might be equivalent to 5-wave. It could be in a form of triple zigzag or so. But if the dollar index simply begins to build its 5-wave to the downside, like we've noted here, then the euro is likely to build a strong move to the upside, probably more closer to this wave described in pattern B. So with all that said, I think the dollar index is likely to make a new high around 83.50, and euro correspondingly is looking to come down. I think we have a good chance of a euro coming down, probably testing something like 127, 128 or maybe 127. So we may even find that when the market opens, if there's some good news, then in order to trap many more people, it will probably do gap open high, and then for the whole week continue declining. Or it could be that it would gap down and just continue down like it did last week. But either way, I think 127, 128 to 127, I think is highly likely based on what I just discussed. And then in sort of an additional comment with that is, you see the pound, which is another US dollar pair, I think has bottomed, and it's done wave 1, wave 2, wave 3, wave 4, and the ending diagonal as a part of wave 5, which I think is almost complete, and therefore this pound is likely to retrace some of that move and often come back to the wave 4. So so pound could easily come back to 150 area. So if the pound come back to 150 area, then during that time euro could also make that new final move to the downside. And while the pound is coming down and the euro is coming down, then Swissy will come down or weaken against the dollar. Then chances are that the dollar will start making a run to the upside almost from the beginning. And that's why I'm expecting that either way, but more likely, euro is going to gap down and is going to continue down for the rest of the week. So that is my expectation from these several charts that we looked at, and why I expect euro to weaken during the whole next week. And toward the end of the week, we will be coming to end of the quarter, and that would mark a natural boundary from where euro could then begin to run up. Okay, and the other point that I had in just a quick analysis and pointing out is, when you look at this, noticeable highs and lows, when were they formed? You see this high over here was formed in March 1985. You come to here, this one was formed in February, back end of February. Okay, if you look at the lows, then the lows are like August and November. So if this high is formed in March, it would coincide with the fact that euro often tops, not euro, but the dollar index often tops in March, and so we would be looking for dollar index topping out now and continuing a new downside leg in a 5-wave motion fairly soon. So in that case, I would expect euro to continue rising up and make a significant move to the upside, and might even offend some analysts or some commentators or to common individual they may find it very difficult in justifying fundamentally why euro should really strengthen that much. But purely from chart perspective, I think that is where we are. There are also other indications suggesting that there is a overwhelming bullishness on a dollar index. So that again is another reason why dollar index should be topping soon. But it's still got one more leg to go to complete the 5-wave move up, and for that period euro will come down 28 to 27 as a broad 2 boundary where we could see a bottom forming. So I hope you like this. I will post this particular video link along with the chart that I'm going to publish shortly, and I would be happy to receive your feedback, positive constructive feedback, or comments, and you can contact me on Twitter as DanGV. Thank you for your time.